What is appraisal gap coverage? My name is RJ Baxter with Fairway Independent Mortgage. I hope you guys are having a great week. And I'm going to dive into that question this week because it's a big one that's going around the industry right now. Lenders are offering this appraisal gap coverage. Also, I've heard it called appraisal gap insurance. So I wanted to explain what this is and what exactly is going on. So first of all, what is an appraisal gap? When you make an offer on a house in today's marketplace, you're trying to do anything you can to make your offer more competitive. And one of those things is to offer an appraisal gap, meaning that you're willing to offer or you're willing to accept an appraised value that's lower than the sales price. So what lenders are doing to help protect the buyer in this situation, to not have to cover that gap, because that can potentially be a lot of extra money out of your pocket. If the appraisal comes in low, you have to cover that difference as the buyer and then apply your loan parameters to the lesser of the appraised value or the sales price. So it turns into a lot more money out of your pocket. So what lenders are doing is they're getting creative in their financing in order to enable you to keep the same monthly payment and about the same out of your pocket by using mortgage insurance. So let's take an example. Let's say you're putting 20% down on a $500,000 home. So that's a $100,000 down payment. And that's an 80% loan to value ratio loan. That's a term that we use in the mortgage industry. And under that circumstance, there's no mortgage insurance involved. So mortgage insurance is only for loans that have less than 20% down. So let's say that your appraisal comes in low. Let's say it comes in at $450,000. So now you'd have to come out of pocket with a lot more money. You'd have to come up with the difference between the sales price and the appraised value, $50,000, and then put 20% down based on the $450,000 appraised value. So you'd come out of pocket with $140,000 instead of $100,000. So what lenders are doing is they're getting creative with using mortgage insurance to keep your payment the same and keep your out of pocket about the same. So if the appraisal comes in at $450,000, you can still borrow $400,000, but we're basing that loan to value ratio number that I was telling you about on the appraised value, because that's the lesser of the appraised value and the sales price. So this would be a 90% loan to value loan now if you still borrow $400,000. So in this circumstance, you would have mortgage insurance. So mortgage insurance takes two formats. There can either be monthly mortgage insurance, which a lot of you may be familiar with, but there's also single premium mortgage insurance, which can sometimes not be too bad as far as that single fee. And what lenders are doing is they're structuring this single premium mortgage insurance into your loan so that you keep the payment the same and you don't come out of pocket with any more money. So it's a creative way to overcome the appraisal gap, keep your payment the same, and not come out of pocket with more money. So that's just a little bit about how this appraisal gap coverage works. So give me a call if you have any questions on this. If you're watching this video and that didn't make sense, it can get a little bit complicated, a little bit techy, a lot of numbers involved there, but that's basically what lenders are doing. That's certainly something that Fairway and my team can offer to you as a buyer or help your clients if you're a real estate agent watching this. So also give me a call if you have any questions related to anything else loan related. Be happy to talk to you about that. And you guys have a great rest of your day. Thanks for watching.